Welcome back to WealthWise, the place where strategy and clarity collide. What if I told you that the biggest obstacle standing between you and financial freedom isn't your paycheck, it's not the economy, and it's not how much your rent is? It's something much quieter, much more personal. It's a set of invisible scripts running in the background of your life every single day. Today, we are pulling back the curtain on a topic that affects nearly everyone, whether you're just starting your career or you're decades in. We're exposing the 7 hidden habits silently sabotaging your wealth. Our guide on this journey is a voice of incredible clarity in a very noisy world. He is a renowned financial strategist and best-selling author, Max Wise. And by the end of this conversation, you will understand 3 critical things. 1, why the common advice to just cut your lattes is a dangerous distraction from the real issues. 2, the powerful psychological trick behind buy now, pay later and 0% financing that's designed to keep you in a cycle of debt. And 3, most importantly, how to turn your most valuable non-financial asset into a machine that actively generates wealth for you. Max, it's an absolute pleasure to have you here.
Sarah, the pleasure is all mine. Thanks for having me. This is a topic I'm incredibly passionate about.
I can tell, and that's why I'm so excited to dive in. So let's start at the 30,000-foot view. You've worked with thousands of people from all walks of life. Why is this topic, these hidden, destructive financial habits, so profoundly misunderstood even by smart, hardworking people?
That's the perfect question to start with, Sarah. It's because we're fighting an invisible enemy. We're taught to look for external villains. A bad economy, an unfair boss, rising inflation. And while those things are real factors, they are not the root cause for why most people stay stuck. The real battle is internal. It's against societal programming and the financial default settings we inherit without ever questioning them. These habits are misunderstood because they feel normal. They're what our friends are doing, what we see in advertisements, what we've been conditioned to accept as just the way things are. Let me give you a stark example. There was a video that went viral recently, and it was heartbreaking. It showed a mother telling her teenage son not to get a job. And her reasoning was, if he earned an income, the government would cut off his welfare benefits and his housing assistance. Now, that's an extreme case, but it's a tragic, real-world example of a widespread mindset. The belief that some external system, be it the government, your employer, or even a lottery ticket, will take better care of you than you can take care of yourself. It's a mindset of dependency.
That's a powerful and unsettling image. Most of our listeners probably wouldn't see themselves in that specific situation, but you're saying a softer version of that dependency exists in many of us.
Exactly. The softer version is everywhere, and it's insidious. It's the employee who feels underpaid but waits for a 3% annual raise, instead of actively building a skill that could double their income. It's the person who throws money into a hot stock because everyone else is, without understanding the business they're investing in. It's the I'll start saving when mentality, when I get a promotion, when I pay off my car, when things calm down. It's a passive approach to what is fundamentally an active game. Wealth isn't something that happens to you. It's something you build, brick by brick, through conscious, deliberate action. And the foundation of that entire structure isn't a high salary. It's a set of productive, empowering habits. These bad habits we're going to discuss today are so dangerous because they masquerade as convenience or even as rewards. They whisper, you deserve this, or it's only a small monthly payment. But what they're really doing is mortgaging your future for a moment of temporary relief in the present. They're the silent architects of a life lived in financial anxiety.
The silent architects, that really lands. It reframes it from being about a lack of money to a lack of intention. So you've set the stage perfectly. It's not about blame, it's about awareness. Let's get tactical. Let's start breaking down these 7 habits one by one so our audience can identify them in their own lives. Where do we begin? Max, that reframing of our relationship with external systems is the perfect foundation for this. It's not about blame. It's about taking back control. So let's get tactical. Let's start with the area where most people feel the daily struggle: spending and debt. A phrase I hear constantly, a justification I see all over social media is, "I can afford the monthly payment." Why is that specific line of thinking so deceptive and dangerous?
It's deceptive because it cleverly redefines the word afford. It shifts the definition from, do I have the cash to own this outright, to, can I handle the small recurring pain of this payment for a while? And that shift is where the trap is set. This is habit number 1 and number 2 combined. You buy what you qualify for, not what you can afford. And it's a psychological masterpiece engineered by marketers. Let's use the classic example from your outline. A new $1,200 iPhone. The thought of spending $1,200 at once creates a significant pain of payment. It's a huge, noticeable dent in your bank account. Your brain screams, warning, that's a lot of money. But when a company offers it for 6 easy payments of $200 with 0% interest, the pain is almost completely anesthetized. $200 feels manageable. It feels light. It's not philanthropy. It's brilliant marketing designed to lower the barrier to entry so dramatically that you stop thinking critically. And they know 3 things will happen. First, as we discussed, their sales volume skyrockets. More people will say yes to $200 a month than to $1,200 today. Second, and this is the subtle part, once that initial pain of payment is removed, you become a much easier upsell. Your brain, no longer guarding your wallet so fiercely, says, well, since I'm already on a payment plan, what's another $15 a month for the insurance, or another $10 for the premium case and screen protector? Suddenly, the company isn't just selling you a phone, they're selling you an entire ecosystem of accessories you might have rejected if you'd paid the full $1,200 in cash up front.
Because the pain of that initial big purchase would have made you much more frugal in that moment.
Precisely. And the third reason is the real kicker. They know that a statistically significant number of people will, for one reason or another, miss a payment or fail to pay it off within the promotional period. The moment that happens, that friendly 0% APR vanishes, and it's often replaced by a monstrous 25%, 29%, or even higher predatory interest rate, sometimes applied retroactively to the entire purchase amount. They win on the front end with more sales and upsells, and they win on the back end with high-interest debt. This ties directly into another insidious habit that props up this behavior: rewarding yourself for being broke.
That sounds counterintuitive. Can you break that down?
Picture this. You're behind on your bills, work is a nightmare, you feel completely overwhelmed and burnt out. You're in the thick of it, and you decide you deserve a mental health day that involves a $300 spa package or a shopping spree that you put on a credit card. What have you just done? You've rewarded the struggle, not the victory. You've rewarded the effort, not the outcome. It's the financial equivalent of a participation trophy. It feels good for a moment, but all you've done is dug the hole you're in a little bit deeper. You're trying to solve a stress problem caused by a lack of money by spending more money that you don't have. This isn't to say you shouldn't take breaks. You absolutely should. But a break doesn't have to cost money. A walk in the park is free. Calling a supportive friend is free. A break and a financially reckless reward are 2 very different things. The rule is simple. You have to get out of the swamp before you stop for a picnic.
Get out of the swamp before you have the picnic. That's a powerful visual. It really drives home the point. So the first step is to break that cycle of debt-fueled spending.
Yes, and the rule to live by is this, and I want everyone listening to really let this sink in. If an item doesn't put money in your pocket, you do not finance it. Period.
That is such a clear, powerful rule, Max. And it's all centered on money. But you argue in your work that we are fundamentally mismanaging an even more precious and often forgotten asset. What is it? And how is that habit holding us back?
It's our time. It's the only truly non-renewable resource we have. And this is habit number 3. We treat time as if it's free and abundant, but treat money as if it's scarce and sacred. The reality for most people on a path to wealth is actually the reverse. We obsessively guard our money in small, meaningless ways, but squander our time as if we have an infinite supply. We all know someone, or maybe we are that someone, who will drive 20 minutes across town to save 5 cents a gallon on gas. They proudly tell themselves they saved $1.50 on the fill-up, but they just spent 30 minutes of their irreplaceable life and burned gas to do it. What is their time worth? In that moment, they valued it at less than $3 an hour. But the most glaring example of this, the one that affects millions, is our relationship with passive entertainment, specifically things like streaming services.
You're talking about Netflix, but the cost is so low. Isn't that just another one of those latte factor distractions?
It seems that way on the surface, but it's not about the subscription fee. The fee is irrelevant. Let's look at the real numbers. The average American watches over 3 hours of television a day. Simultaneously, the average American household carries over $6,700 in high-interest credit card debt at an average APR of around 25%. Your credit card company is making a 25% annual return on the money you owe them. Your debt is their high-performing asset, and it's compounding against you 24/7. Meanwhile, the person with that debt is spending 3 hours a day. That's over 20 hours a week, a part-time job's worth of time, watching a show. The true cost of that Netflix subscription isn't the $20 a month. It's the 90 hours a month of your most valuable asset, your time, that you are giving away while your financial house is on fire. That's 90 hours you could use to learn a high-income skill on YouTube for free, to start a side hustle, to read 3 books on investing, or to simply sit down and create a budget to aggressively attack that debt. You are in effect making your credit card company rich with your money while you passively consume content instead of actively solving your problem with your time.
Wow. When you frame it as a direct trade-off, 90 hours of potential progress versus 90 hours of passive consumption, it's jarring. It's not about shaming people for relaxing, but about understanding the massive opportunity cost when you're in a financial hole.
Exactly. It's about intentionality. If you are debt-free and your investments are automated, by all means, enjoy your shows. But if you are stressed about money, you cannot afford the time cost of that entertainment. So the question isn't, can you afford the subscription? The real question is, can you afford to spend the time watching it, especially when your debt is working harder against you than you are for yourself?
That reframing of time is a game changer. And it leads perfectly into our final set of habits for this section, which are all about taking that time and turning it into action, specifically around investing and self-improvement. This is where so many people get paralyzed. They either misallocate their resources or are simply too afraid to start. How do we break through this inertia?
This is the final hurdle for many, and it's protected by 2 guardian habits. The first is habit number 6 from the source material, jumping over dollars to save a few pennies. This is the classic penny-wise and pound-foolish mindset, but applied to your own growth. Think of the person who will drop $1,500 on a vacation, a new set of golf clubs, or bottle service at a club without blinking. They categorize it as an experience or fun. But when it comes to spending $20 on a book that could fundamentally change their financial trajectory, or $200 on a course that could teach them a skill to earn more money, they agonize over it for weeks. Is it worth it? Is this a scam? Can I find this for free? They are comfortable spending thousands on depreciating assets and fleeting experiences, but they are terrified of investing hundreds in their own human capital, the one asset that provides infinite returns. It's a profound misunderstanding of value.
And that fear, that analysis paralysis, leads directly to the final habit, doesn't it?
It does. It's the ultimate showstopper. Habit number 7, waiting for permission to begin. I hear it every single day. Max, just tell me what to do. What's the best stock? What's the best brokerage? Where do I start? My answer is always the same. It doesn't matter as much as you think. The obsession with finding the perfect first step is a form of procrastination disguised as diligence. It's born from a fear of making a mistake. Let me offer an analogy I use all the time. It's exactly like getting in shape. People get completely overwhelmed by the infinite details. Should I do a keto diet or a vegan diet? Should I be doing high-intensity interval training or steady-state cardio? Should I lift heavy weights for low reps or light weights for high reps? They'll spend weeks, even months, researching the perfect, most optimized plan.
And in all that time, they haven't set foot in a gym.
Exactly. When the simple, unsexy truth is that the most important thing they can do is just put down the donuts, put on their sneakers, and get on the treadmill. Just start moving. You can optimize your diet and workout splits later. The first step is to build the habit of showing up. It is identical with building wealth. Don't worry about finding the perfect stock or the perfect mutual fund. The first step is just to get on the financial treadmill. Open a brokerage account. It takes 10 minutes. Put in $50, an amount you are psychologically comfortable losing. Buy a share of a simple, broad market index fund, like an S&P 500 ETF. The moment you have real money in the market, even a tiny amount, everything changes. You'll start paying attention. You'll read the news differently. You'll start to learn. You have to be willing to be a beginner. You will make mistakes. I have made a ton of expensive mistakes. But losing a little bit of money on your first few tries is the tuition you pay for your real-world financial education. The key is to start small, so your mistakes are cheap lessons, not devastating losses.
So the goal isn't to be perfect from day one. The goal is just to start on day one.
That's it. You have to give yourself permission to be clumsy. Give yourself permission to learn. The cost of inaction, of waiting another year to start, will always be infinitely higher than the cost of a small, early mistake.
Wealth isn't built by avoiding every mistake. It's built by starting, surviving the mistakes you inevitably make, and having the courage to stay in the game. Max, that last point is so critical, the willingness to start, to be a beginner, to learn from mistakes. It's something we talk about conceptually, but it's another thing entirely to live through it. It sounds like you're speaking from experience. So I have to ask, was there a specific moment in your own journey, a failure or a breakthrough, where one of these habits hit you personally and permanently changed the way you think about money?
Oh, absolutely. The lesson is never as powerful as when it costs you real money and a piece of your ego. For me, it was a classic case of jumping over dollars to save pennies, and it happened when I was in my early 20s. I had just started making a little bit of money from my first real job, and like a lot of young, ambitious people, I was dangerously overconfident. I thought I was smarter than the market. I was at a barbecue with some friends, and a guy I knew, who seemed successful, started talking about this can't-miss stock. It was a small biotech company, he said, on the verge of a massive breakthrough with a new drug. He was so confident, so convincing. It was the classic hot tip. And the younger, more foolish version of me got completely hooked. The idea of getting in on the ground floor was intoxicating. So I went home that night and started doing my research, which basically meant I read a few positive headlines and looked at the stock chart. Deep down, I knew I was cutting corners. I found a detailed 20-page analyst report on the company from a reputable research firm. It promised a deep dive into their clinical trials, their financials, their management team, everything I actually needed to know. The problem? It cost $199.
The price of admission for real knowledge.
Exactly. And my brain immediately went into that penny-wise, pound-foolish mode we talked about. I thought I would spend $200 on a report when I could use that same $200 to buy more shares of this rocket ship. I can get the information for free online, right? I let my impatience and my desire for a shortcut override my logic. I chose the free speculative tip over the paid professional insight. So I took $2,000, which at the time was a huge chunk of my savings, and I put it all into this one stock. For the first 3 days, Sarah, I felt like a genius. The stock went up 10%. I was checking my phone every 5 minutes, watching the numbers climb, already mentally spending my future profits. I was a brilliant investor. Then on a Tuesday morning, I woke up and checked my phone, and I felt that sickening, cold drop in my stomach that anyone who's made a bad investment knows. The company had released news overnight. Their flagship drug had failed its late-stage clinical trial. It was a catastrophic failure. In less than an hour, the stock had lost over 90% of its value. My $2,000 investment was worth maybe $150. It was practically gone.
Wow, that's a brutal lesson.
It was brutal. I felt foolish, embarrassed, and angry. But after the initial sting wore off, the real lesson began to sink in. I didn't lose that money because of a bad tip. I lost it because of my own arrogance. I lost it because I was unwilling to invest in my own education. That $1,850 loss wasn't a fine. It was tuition. It was the tuition fee for the most important course of my financial life. The lesson was this: the stock tip was free, but the lack of knowledge cost me nearly $2,000. The analyst report that I refused to buy for $199 would have been the single greatest investment I could have made that day, because it likely would have saved me from losing 10 times that amount. From that day forward, I made a promise to myself. I would never again be too cheap to invest in my own knowledge. The cost of ignorance will always be infinitely higher than the price of education. Your best investment isn't in a stock or a fund. It's in the 6 inches between your ears.
Max, thank you for sharing that. It's such a powerful human story, and it perfectly illustrates the principle. It's about building a foundation of knowledge first. Speaking of building, that story is a great example of learning from the past. I want to shift our focus now to the future. With the world changing so rapidly, if you had to bet on one single shift in the next 3 to 5 years that will define financial success, what would it be?
That's a fantastic question. If I had to place one bet, it would be on the rise of what I call financial self-sovereignty. For decades, the average person has been a passive consumer to financial products. You go to a bank, they give you a generic risk profile, conservative, moderate, aggressive, and they put you in a handful of mutual funds. You were a passenger. That era is ending. Technology, specifically the practical application of AI and blockchain, is now handing the tools of the institution to the individual. We're moving from being passive consumers to being active architects of our own financial lives.
That sounds very empowering. Can you give me a concrete example of what that looks like for the average person listening?
Absolutely. Let's take 2 examples. First, AI-driven personalization. Instead of a generic risk profile, imagine a tool that securely analyzes your specific spending habits, your saving velocity, your career trajectory, and your stated life goals, like buying a house in 5 years or retiring early. It can then create and manage a hyper-personalized investment strategy that dynamically adjusts as your life changes. This isn't science fiction. These tools are emerging right now. It's like having a dedicated Wall Street quant, but one that works just for you. Second, the democratization of asset classes through fractional ownership. 10 years ago, if you wanted to invest in blue-chip art, venture capital, or institutional-grade commercial real estate, you needed millions of dollars and the right connections. You were locked out. Today, thanks to technology that leverages the blockchain for secure ownership records, you can go on a platform and buy a $100 fraction of a skyscraper in Austin, a portfolio of promising startups, or even a piece of a Basquiat painting.
So this idea of self-sovereignty isn't just about having more control. It's about having access to entirely new building blocks for wealth.
Precisely. The game is no longer just about buying stocks and bonds. It's about becoming the curator of your own unique, diversified portfolio that might include public stocks, a slice of a rental property, a piece of a private company, and maybe even a digital collectible. The mindset shift required is huge. The winners of the next decade won't be the people who follow the best gurus or find the hottest tips. The winners will be the people who learn how to use these new tools to become the best architects of their own personal financial system.
Max, this has been an incredibly illuminating conversation. Truly. We started by peeling back the layers on the invisible scripts that hold so many people back. We broke down the destructive daily habits around spending, time, and investing. And now you've given us a powerful and optimistic framework for navigating the future. I can't thank you enough for your generosity and wisdom today. And for everyone listening, if you found even a fraction of the value in this conversation that I did, I ask you to do 3 simple things. First, share this episode. The most powerful thing you can do with valuable knowledge is to give it away. Think of one person in your life, a friend, a family member, a colleague who is smart and hardworking but might be stuck in one of these habits. Send this to them. It could be the catalyst they need. Second, if you haven't already, hit that subscribe or follow button right now in your podcast app. That way, you'll never miss these weekly breakthroughs we have here on WealthWise. And finally, for more brilliant insights from Max, you absolutely have to check out his work. We'll put the links to his website, his books, and his social media right in the show notes. Please, go explore it. As you leave us today and go back into your week, I want you to hold on to this one final thought. The conversation we had today proves that financial freedom isn't a dream you just hope for. It's a strategy you execute. And your future isn't determined by the size of your paycheck. It's forged by the quality of your daily habits. Thank you for tuning in to WealthWise.